Alasdair, anybody that takes a look at a long-term Treasury rate chart, U.S. Treasury rates, will see that since about 1980 or so, every credit cycle, saw lower highs and lower lows. I would like you to talk about why that has happened. Can you talk about the dynamics as to why we're seeing chronically lower rates since about 1980?
Yes, indeed. I think it's a function of the increase of the quantity of money without much of an increase in actual production. Mm-hmm. So what we have, in effect, is not so much the prices being eroded, but more and more money in the system. And, of course, you see that people, they look at things like velocity of circulation, which actually is a completely meaningless thing. But what that does tell you is there's just more money in the economy. And, as a result, it doesn't take quite such a high rate of interest to suddenly upset the thing, because the other side of that money, of course, is the debt that has been created. And it's the debt that puts the limit, if you like, on how far interest rates can rise before you trigger the crisis in the cycle. And that is why we've had declining peaks of interest rates ever since the 1980s. Mm-hmm. And we've now got to the point where if we just raise interest rates to, say, 2.5%, 3%, I'm talking dollars here, then the whole system begins to fall over because of the debt. I mean, it's just so much debt around now. It's all been created. It hasn't been washed out. And, of course, we cannot afford to have it washed out for the simple reason that no central banker is appointed to bring about conditions that will bankrupt the economy, bankrupt the banks, and make government funding more expensive. So they've got themselves, if you like, into this final trap, which actually, if you read von Mises's earlier works, the theory of money and credit, you would have been able to deduce that this is the sort of thing that we were going to end up with. But what it means, Jay, is that you've got a problem that when it comes to reducing interest rates in order to save the world the next time, your computer model probably says that you need to reduce it by an average of about 5%, going back, seeing what happened last time, the time before, and so on and so forth. So how do you reduce it from 5% by 5% from 2.5%? Well, the answer is you can't. You have to go negative. That's what the model tells you. And fortunately, in a sense, I suppose, central bankers are naturally cautious about having such extreme policies to try and rescue the economy. But the problem they have is they're going to get themselves into a bind, I believe, and I'll say a little bit more about that in a second. But they risk getting themselves into a bind in a sense where they think, well, the only option is to go negative. And then that has very, very serious consequences, because it puts the whole of the commodity complex into backwardation. Now, I should draw a distinction between the dollar and the other major currencies, particularly the euro and the yen. The difference with the dollar is that we price all our international trade, we price our markets in dollars, not in euros or yen, so that the ECB and the Bank of Japan can reduce their interest rates into negative territory, putting aside whether this is wise or not. That's a different issue. But the point is they can do it without bankrupting the global financial system. But if America does it, just think on this. Everything goes into backwardation. And what that means is there is a huge incentive for us all to buy commodities, to buy, if you like, the things that we usually use, rather than hold dollars. So suddenly we have got the reason to basically get rid of all cash dollars, all dollar deposits. And then what does that do? It collapses the purchasing power of the dollar. Now, I don't know whether central bankers actually realize that this is the dynamic that they're now faced with. But, you don't even have to go negative to get to that situation. If you remember back to the wake of the Lehman crisis, yes. Interest rates were reduced to zero as part of the monetary package to deal with that. Mm-hmm. Now, having reduced those interest rates down to zero, when it became clear that the whole system wasn't going to fall over, the gold price then rallied strongly from about $740 up to, I think it was $19.20 in September 2011.
Right.
Now, that was as far as it got. So it went up, it more than doubled. We got to the stage where, it sort of then paused. And then it became clear that there was going to be, at some stage in the future, economic recovery. Now, what that meant was that at some stage in the future, dollar interest rates would start rising. Mm-hmm. Now, from the point of view of the bullion banks in the system, they then moved from the situation where they had to close down their dollar obligations against their gold obligations. So they had to begin to cover those, which is one of the reasons that the gold price was driven so firmly upwards. And then when they could see that interest rates on the horizon were likely to rise, at that stage, the pressure came off gold.
I see.
We are now in exactly the same situation. And I'm at the moment drafting an article which will go out on Thursday on precisely this point. Because the thing that people just don't seem to realize is that gold has an interest rate. The best way to describe it is time preference.
Yes.
You have some gold. If I want to borrow your gold, you are going to lose possession of that until I return it to you. Basically, you value the possession of the gold more than you value non-possession. Mm-hmm. So if you're going to part with that gold, there is a rate which I would have to pay you in order to persuade you to part with that gold for a period of time which we would agree with us. I think that's pretty uncontentious. But what that does mean is that gold has an interest rate because that time preference is represented by an interest rate. Now, if you also extend that to the dollar has a time preference element. And an interest rate. Now, we don't see that in the sense because the central banks have taken over control of the pricing of interest on the dollar. So we're not allowed to have a time preference on the dollar, except to the extent that the central bank allows us to have one. Mm-hmm. Now, if you compare the two, the time preference rate on gold and the time preference rate on the dollar, if you reduce the time preference rate on the dollar, let us say, call it an interest rate below a certain level, then obviously, this is going to favor holding gold rather than holding the dollar. We put aside all considerations about unsound money and all this sort of stuff. Yeah. Just think in terms of time preference.
Sure.
So we now have a situation where it makes more sense to hold gold than dollars. Now, the bullion banks who have geared up and are synthetically short of a lot of physical metal have a problem when the dollar rate falls below the gold rate. Mm-hmm. And that more or less is where we are at the moment. If you look at and this is just a rough guide, the forward rate for gold is around about 1.9% per annum. LIBOR is around about 1.9% per annum for a year. So if you take the two together, what have you got? You have got zero for the time preference for gold. So already we're in a situation where the bullion banks are having to switch from having a little bit of gold, financing interest rate swaps and arbitrages and all the rest of it in dollars, to a situation where they should be closing out their gold obligations. Mm-hmm. And if interest rates in the dollar go any lower, they should be holding on to a small pot of dollars in order to buy a larger pot of gold and other commodities, which also have time preferences.
Sure.
So So this is, I mean, it's important to grasp this point because we've seen gold now move very rapidly from, in the last few months, very rapidly from sort of 1350, 1360, which was seen as a rock solid barrier. And tonight we're looking at $1540. And that's over a fairly short period of time. What is happening is that there's the fundamentals that are going on about time preference for gold relative to time preference for dollars. Now we have a problem. How far is this going to go? Mm-hmm. Let's look at the overall economy. I think you and I, we've discussed this so often, can agree that we have come towards the end of the credit cycle, the expansionary phase of the credit cycle, and we are likely to tip into, that sort of periodic recession, which you alluded to by bringing forward the interest rates, the declining interest rate peak story. So we've got that. On top of that, we have got the problem of President Trump's tariffs against China. Mm-hmm. Now, this is exactly the situation we had in 1929 to 1932, which, first of all, knocked Wall Street down top to bottom 35% in October 1929. It recovered somewhat until Smoot-Hawley was actually signed into law by President Hoover, which was, around about April, May 1930. And, then, of course, you had this slump in the 30s and all the rest of it. Now, what nobody has actually researched is the synergistic effect of the trade tariffs on top of a turning credit cycle. Now, if you put those two things together, you can come up with an explanation as to why the depression, firstly the fall in Wall Street, but also the depression in the 1930s was so deep. Mm-hmm. Now, if I'm right in drawing that empirical evidence towards us, then what we face is not just a sort of downturn in the global economy, which can be corrected by, a temporary expansion of the quantity of money, a little bit of QE and maybe not knocking a half or a point off interest rates. Right. It's a lot more serious than that. Now, if it is more serious than that, then our negative interest rate play is going to become a real possibility, first in the Eurozone and also in Japan and various other central banks like the Swiss, the Danish and the Swedish, who are already there in a small way. Yes. They're going to go deeply negative. And the pressure on the Fed to not only go down to zero, but maybe go that little bit further is going to become intolerable. Yeah. Now, then we have this problem. If you're a bullion bank and you're sitting there, you can see that interest rates are already going against your operations, whereby you gear up on a small amount of gold. That is already being killed in the current situation. Mm-hmm. So what's the outlook? Well, the outlook is it's going to get considerably worse. It's not like 2012, where suddenly you could begin to say, the Cyprus crisis and all the rest of it, we've gone through that, and actually we have survived. The global economy is going to survive. Dollar interest rates at some stage in the future are going to go up. We can hang on. We can bash the gold price. We can get back into business because, the problem is now dealt with. Mm-hmm. The problem this time is not dealt with. The problem is going to get worse and worse and worse. So what do the bullion banks do? They have to close down every outstanding gold liability. Otherwise, they are likely to go bust. Wow. And that is why the gold price is so strong. It's got nothing to do with, at this stage, nothing to do with we've got the charts are looking good, or there's so many thousands of dollars, per ounce of gold, forget all that. So it's the banks that have the trouble.
So the bullion banks are covering their shorts. They're starting to cover their shorts. Is that what you're saying?
Yes, they're beginning to do it. I think you'll find the big boys are beginning to do it. Whether the smaller ones have actually caught on to this, they must do to an extent, simply because, for a start, they see the price run. Yeah, this is something. This is something which is new, and they will be looking. I mean, because if you've got to pay an amount to borrow gold, why are you doing it? You're doing it to get into an arbitrage into something else,
right?
And if your arbitrage is a dead loss, then all you've got is a gold liability, and that's the thing that is driving the price.
Very interesting. Well, Alasdair, I'd like to explore just a little bit more the backwardation comment that you made. Why commodities will go into backwardation? Because the currency becomes worth less, and also why, if you can help me understand again the difference between the U.S. owning the world's reserve currency and the euro, for example. Why we can't do it? We can't go negative, whereas they can.
Well, it's not quite as you say. Basically, the reason that there will be a backwardation across the whole commodity complex is because you have negative interest rates. Remember that every item there is, every good, has an implied time preference.
Sure.
Yeah. So it's not just gold. Gold, in its monetary sense, actually acts as a proxy for all the other commodities, and incidentally, anything that you or I might buy if we were using gold as money. So the problem then is that if you've got negative interest rates, instead of the price of copper being, let's say, what happens is the price today is 2,200. The price, let's say, for a month's delivery is 2,100. So you've got a backwardation. But the backwardation isn't because people are buying copper. The backwardation is forced on the market by the monetary policy of the Fed.
I see.
Now, getting back to your question as to why it's a dollar and nothing else, it's really quite simple. All commodities internationally are priced in dollars.
Okay.
Yeah, not euros. So the euros can do it. Forget, and they will create their own problems, but they won't necessarily upset the apple cart in the way the dollar would certainly do so.